Hello, students. This is a subject of finance and credit, and today's topic is banks. Okay. So the purpose of this lesson is to provide you with a general idea of the banks. Okay. Provide in order to make you understand how the banks works, about their functions, and about regulations done to the banks. Okay. Bank. What is bank? So banks, it's an organization or it's a financial intermediary that connects people. Okay, it means that they connect people who have a lot of money or extra money, and take it from them and give it to people who need money. Okay, people who need money or who don't have money. Okay, so so giving this money means loaning. Okay, so banks. Can give these lending activities through two ways. Okay, they can directly give loans to the people, or they can engage in the financial markets by buying securities. Okay, so and the next slide. Overview. So banks are very crucial and important organizations in the financial system because it provides the financial system with the money. Okay, so it makes it easier access for money for many institutions and companies. Okay, so that's why it have to be it must be highly regulated. Okay, so there are some kinds of regulations. The main type is fractional reserve banking. So fractional reserve banking means that banks they cannot hold more assets than of their deposits. Okay, so it means that uh, they have to be able to cover their deposits. So that's why their assets must be higher or equal to their deposits. Okay, and next comes minimal capital requirements. So it's another regulation, and according to this requirement, so banks have to have a minimum amount of money. Without this, they cannot operate or open banks. Okay, and history. So banks have been evolved. Banks have been evolved long years ago. For approximately in the 14th century. Okay, so in the 14th century, first banks began to operate in the Italy. Okay, so the World Bank itself has arrived from the Middle French and from Old Italian and Old High German. Okay, so it means in German it derived from the German World Bank, meaning bench and counter. Okay. So next slide. So there are channels. There are channels that bank can provide their services. Okay. So and the first one is automated teller machine. Automated teller machine. It's a very uh, very useful because it uh, allows people to receive services by not going directly to the bank. Okay, so these automated teller machines can be found in different places. For example, you can find them at large shops and big organizations in the areas where a lot of people live. Okay, and next comes branch. So branch means it's a organization of the banks that is uh, located in different cities. Okay, for example, in cities where the population is higher. Next, call center. Call center means that nowadays people can access the bank service through calling. Okay, by calling. And next comes mail. So mail, it means that they can receive services by going to the mail. And next comes mobile banking. Mobile banking, as technology has improved, nowadays people can access to the banking services through using their smartphones. Okay, there are applications of the banks that enable people to access these services. Okay, and next comes online banking. Online banking is also very useful because it enables people to access services in their house or in their business whenever they want. Only is needed is only thing is needed is internet and computer. Okay, if you have computer or laptop and internet, you can access the banking services through the online banking. Uh, and the relationship managers. So these are workers that can directly go to your house and provide banking services. And telephone banking, as I said, through the telephones. Video banking means so you can communicate with banking managers through the video conference applications. For example, Zoom or Skype. Okay, and the next is direct selling agent. So these are also people workers who can contact people outside the bank. uh, and business model. So a business model means how the bank generates the profit. So main profit of the bank is by charging interest. Okay, through the interest. So it means that they charge interest on loans and give interest to the deposit holders. So the profit is derived by interest of loans minus interest of deposits. Okay, and the next way of receiving profit is through the fees and financial advice. So it is more stable than of interest because this is more stable, and the banks nowadays they make more efforts to increase this type of profit. Okay, uh, and next, so measures taken to ensure profitability. So nowadays banks have to take some measures in order to make sure their profit is stable. Okay, so first one is merging with investment and insurance houses. So it allows banks. So banks have to merge with investment companies and insurance companies. Okay, by doing this, they ensure the clients of the banks, so they become more safer. Okay, for example, most banks in the Kazakhstan have insurance. Okay, state insurance. So it means that if the bank cannot meet your deposits, cannot cover their debts, the go government come to help. Okay, by these insurance programs. Okay, and the second one is use of risk-based pricing. So it means that you have to give higher interest rates to risky customers. Okay, you have to give loans to higher risky customers with high interest, and you have to give lower interest rates to safe customers. Okay, so it's a method is used by a lot of banks. And the third one is increasing of the methods of payment to clients. So it means that you have to if you uh, if you increase the methods, for example, debit cards, smart cards, and credit cards, you can uh, enlarge, you can make increase your customers, because increase your number of customers. Okay, for example, debit cards allows people receive money through the automatic teller machines, and smart cards and credit cards enables people customers to receive money through the cards. They are not have to they don't have to go to the banks. Okay, so it's also profit can be taken from these operations, from debit cards, smart cards, and credit cards, in the form of interest and fees. Okay, so risks. So every organization have its risks, and bank is not exception. Okay, so credit. The first one is the first main risk is credit risk. So credit risk means that if the borrower do not return the money, do not return the loan. Okay, and the next one is liquidity risk. Liquidity risk means that if asset cannot be traded quickly to prevent a loss. Okay, and the next one is market risk. Market risk means that if the mm, if the value of the loan or value of the product uh, will decrease in the market. Okay, so it's also risk. So next comes operational risk. Operational risk means that if you cannot operate it depends on the execution of the operations. Your you're managing the operations of the bank. Okay. Next comes reputational risk. Reputational risk is also important because if you lose your reputation, it will be difficult to work, to function, to operate. Okay, and the last one is macroeconomic risk. So macroeconomic risk means that even your bank is working or operating better, so there are some conditions that can affect your business. For example, if there is a crisis, or inflation or devaluation in the macroeconomic scale or in the country where the bank is located, it will affect surely the banks. Okay, and capital. So bank capital mainly consists of these three items. Okay, the first one is equity. What is equity? Equity is a capital. It's a money. Money. It's a money formed by selling stocks and shares. Okay, and next comes retained earnings. Retained earnings is all the profits that have been accumulated. Okay, and the last one is subordinated debt. So subordinated debt means deposits that you received from clients or the loans, credits that you take from other banks or from the uh, central bank. Okay, and next, bank types. So there are a lot of types of banks. These are some examples. For example, the first one is retail bank. So retail bank, as it says, it works only with individuals or small business. Okay, so it means that its capital much more less. Okay, and next comes business banks. So business bank is larger than retail banks, and it works with mid-market business. Okay, and the next comes corporate banks. Corporate banks, it's a big banks, and they work with the large business entities, with corporations. Okay, and next comes private banks. So private banks, they work mainly with individuals, but with wealthy individuals. Okay, with rich people. And the last one is investment banks. So investment banks, it's very different from the others because they do not give loans or they do not receive deposits, but instead they make investment activities. So it means that they engage in the uh, capital markets. So it means that they buy stocks and bonds. Okay, and subtypes of retail banks. So retail banks itself are divided into community bank, community development bank, private bank, offshore banks, savings banks, and postal savings banks. Okay, these are types of retail banks. So these are types of retail banks, and I want to make a special accent on offshore banks. So offshore bank, it's very popular now, and offshore means that this bank is located outside the country, and the law is not enforced, and they have no taxation in these banks. So that's why, and they have privacy rights. Privacy rights. It means that if you put money on these banks, you are not required to tell them from where you have taken the money. Okay, so these are advantages of the offshore banks. Typical advantage is greater privacy, as I said before, and little or no taxation. So it means that uh, you are not, you are not, you will not be taxed if you uh, provide money, if you give money to the offshore banks, and easy to access to deposits. And the last one is protection against local, political, or financial instability. Uh, and other advantages. So these offshore banks have a lot of advantage, but there are some also disadvantage of offshore banking. Okay, so it means that in spite they are very praised, there are some disadvantages. For example, they are less financial secure, and it means that if you put money on these banks, and if the bank goes bankruptcy, nobody knows, because uh, your account and your money is very private. Okay, and offshore banks. So these are a list of offshore financial centers. So as you see from this list, that most offshore banks are located in islands. Okay, in the islands, not in the mainlands. For example, Antigua and Barbuda, Barbados, Bermuda, all are the islands uh, in the America. Okay, in the America, and these are all countries. Almost all of them are located in the islands. Okay, and the popular ones are Cayman Islands and Switzerland. Okay, I think that's all for today. Uh, so see you soon. Goodbye.